Good morning and welcome to Monday's Join the Dots. I'm going to do a bit of a recap as well as some new information today, but I think we sometimes need to just recap what we're trying to achieve here. What I'm trying to achieve for you is to provide information that you would not otherwise see, hear, ever experience. Because as I've said to you at the beginning of this series of YouTubes, this big journey that we're taking on Join the Dots, I spent 5 years. Before that, I spent 20 years doing a lot of work, but I spent the last 5 years intensely trying to narrow down the good voices and identify the good, reliable, clear voices from the absolute noise out there. Now, I'm not being rude to traders, but most of the noise comes from traders because they're trying to create a trade, and that's fair enough. That's what they do. My job, in my world, in my eyes, is to give you the information to allow you to be informed. I can't give you trading advice. I can't give you financial advice. Okay, I'm not here to do that. I'm here to inform you such that you can then make a more rational decision after doing some research. And I keep saying that every video, do some research. Again, you work how many weeks a year, how many hours a week to earn your money? And you don't spend that much time protecting everything you made in all your life. Come on, let's get realistic. You have to work. We all have to work at it. Okay, I'm just trying to make it easier for you by filtering that information down to some voices that make sense. And we had that horrible moment yesterday where I had to do that emergency broadcast because what I heard is not good from Martin Armstrong. And it's something I felt in me for a long time now, and I feel it in Asia as well, because the people of Taiwan must be constantly worried about what will happen with China. And it's the same problem. When all else fails, when your economy is failing, when your people are unhappy, when everything's going wrong, when you've lost the leadership, what do? You go to war with no consequences for you, only for the people who have to fight the useless war. It's very sad. And I've been warning my clients for 4 years now that Taiwan looks to me like the Falklands did to Galtieri in Argentina, where he'd lost the economy, the whole thing was collapsing. So what did he do? Invaded the Falklands, everyone cheers, flags waving, everyone's happy for a while, until Britain went down there, took the Falklands back, and then Argentina started again. And one of the stupid things that came out of that, or years after that, was Argentina were able to issue a 100-year bond. And yet they've been bankrupt 17 times or something. It's pathetic what these markets will do. But they don't care as long as they can pass it to you. And that's what they're going to do with bonds in the next 12, 18, 24 months. They're going to pass them through to your pension funds. They're going to pass them through to you. They're going to get rid of them and they're going to take the money. So we've got to be careful. And I did that special show on bonds with the Japanese issue. Russian banks are in almighty trouble now. Okay, you somewhat expected that really. They're in mighty trouble. So they've got 5 to 6% bad debts. Now, if you understand banking, the bank has about 5 or 6 or 7% of equity of shareholder funds, even with its retained profits. It only has about 5 or 6% of its balance sheet in equity and the bank's assets. The rest is borrowed to lend, leverage. So if they've got 5 to 6% bad debts, guess what? They've got no equity left. They're essentially bust. But of course they won't show that until it comes to a crunch where they have to show it. And we saw that in 2008, didn't we? With Bear Stearns, with Northern Rock and with Lehman. Not in that order. But we saw it in 2008. We saw banks go bust. Okay? And we're going to see it again. Because if you think about it, Russian banks are now basically just about solvent, maybe just slightly insolvent. Chinese banks are insolvent 50 times over. I don't care what any data, I don't care what data anyone shows me. The Chinese banks are so insolvent, and yet you won't see one report on it. Amazing. So we've got problems with the banks, okay, and we've got problems with Europe. French banks are going that way. Canadian banks, Australian banks, UK banks. Why? Property. American banks. Property. So what I'm saying to you, and what I said to you yesterday, was that there is a move by the banks now, and this was pointed out by Jeff Schneider of Eurodollar University. There's a move by the banks to take on board bonds, short-dated bonds, lots and lots of short-dated bonds. Buy. Why? Because they need them to act as collateral when they have to borrow out of desperation from the Fed or from their own central bank. They're going to have to borrow out of desperation, and they need that collateral. But what does it mean? Well, if they're buying all these bonds and putting them on their balance sheet, they haven't got balance sheet room for loans, have they? Or they've got reduced space for loans. So they don't lend as much. Happening in China, happening in Russia, happening in America. They're not lending so much. So guess what? The market starts to go illiquid. Companies can't borrow at a cheap rate. Now, this means rates, the yield curve starts to steepen, okay? The further out you want money, the more you're going to have to pay. And this could happen to the US Treasury soon. It really could. It could happen to the US Treasury. We could see the Fed might cut at the short end, but the long end might rise. Because the risk as the Fed cut and create more money, which creates more inflation in a market that is struggling, it's not good. And therefore people will say, well, I'm not going to hold a 10-year risk for 4.5. I want 5, I want 6, I want 7. Can you see that? And that means the banks then are taking on all these short-term assets, but they've got long-term loans, haven't they? They've got mortgages. They've got 30-year mortgages. They probably packaged a lot off, but they're probably holding a lot as well. They've got a lot of long-dated loans, and they've got a lot of short funding. Sounds like Northern Rock. We're heading that way. Let's go back to silver and gold, because I wanted to remind you of some things here. And there was some numbers came out this morning, which I saw. Hedge funds in the States. Hedge funds now have $5.7 trillion with them. 5.7. And do you know what their average rate of return was in the first 6 months of this year? 3.88. I kid you not. So 5.7 trillion has gone into the hedge fund industry, and they've made 3.88%. 3.88. And I looked, just out of interest, I thought, well, what have I done? Well, I've got my gold, Agnico. Well, that's up year to date, 44%. Okay. Pan American silver, my silver share, year to date, 31%. Wow. And don't even talk about XRP, because we're $3.50 at the moment. As I talk, I bought them at 50 cents last November. So there's going to be a lot of disillusionment in the markets. There's going to be a lot of people who are unhappy with what their returns are, especially in a period when the S&P is at an all-time high, when all the markets, Nasdaq, they're all at all-time highs, and yet the hedge funds have returned 3.88%. Some of this money is going to look for somewhere else to go. Where's it going to go? Interestingly, with silver, I looked at my Pan American one, and this is very interesting, and I think you need to understand this. So 31% year to date, but look at a 5 year. Let's look a bit longer. 5 year down 23.5. Why? Because 5 years ago, silver went on a tremendous run in 2021. And it almost hit $50 an ounce, almost. It's only 38 now, but there's a special number in 38. It's one more than 37. Why is 37 special? Because Friday last, 9 days ago, on the Friday, the COMEX was hit, and I'm going to look at this number. The COMEX was hit with shorts for 480 million ounces in 1 hour. That's over half of the global production of silver was shorted in 1 hour on the COMEX. Now, to be shorted, they have to have a balancing item in the LBMA. But the LBMA at the moment only has 155 million ounces, and it's the lowest number it's had on record. The silver market is being played with enormous amounts of money, and those who are playing it are enormously underwater, because they did that at 37. The market's taken it back over 38 now, and that was only 9 days ago. They dumped 480 million ounces in 1 hour, and the market said, thank you very much, off we go. So they're now short. How do they get out of that? They might have to come in and buy it. And if they have to come in and buy 480 million ounces, what happens to the price? Because there ain't no silver. This is where we are. So everything is incredibly unstable. Okay, I'm only giving you that news so that you can realise how unstable it all is. These banks, hedge funds and traders, they've had it so good with zero interest rates and a long period of only upward moves. The reckoning is coming. And then that's why we think, okay, what do we do to defend ourselves through that reckoning? Okay, and that's why we're on our journeys of gold, silver and XRP. Now, I'll come back tomorrow. There's an awful lot I've got written down here which I haven't even talked about because so much is happening. But I think to cut it short there, to make sure we don't get too bored, please like and subscribe. We've broken the 500, okay? It's only taken us 5 weeks. Let's crack on now for the 1,000. Please share. Please ask your people you send it to share. Please ask them to subscribe. It doesn't cost them anything, but it gets the numbers up, and that gives us more spread. And it just fires me up to give you more and more information to help you. Okay, thank you very much. See you tomorrow.